Welcome to this explainer. Today we're unpacking a really dramatic, almost Jekyll and Hyde situation going on over at Metropolitan Commercial Bank. We're looking at their Q1 2026 earnings report, and if you follow regional banking, you already know it's been a total roller coaster lately. But MCB's latest quarter, it's a fascinating case study. We're talking massive top-line growth, violently colliding with sudden, highly concentrated risk. Let's just get right into it.
Okay, let's start with the absolute biggest headline right out of the gate. MCB practically doubled their net income year over year to a staggering $31.4 million. Think about that for a second. In an environment where regional banks are literally fighting tooth and nail just to maintain their margins, a profit jump of this magnitude, that totally grabs Wall Street's attention. But to really grasp how they pulled this off, we kind of need to look at their foundation first. So where does this growth actually come from? Well, you have to look at MCB's roots. They're deeply embedded as a New York City-based commercial bank. They're heavily targeting middle-market enterprises, real estate property management, and municipalities. They aren't trying to be everywhere at once, right? Instead, they maintain this laser focus on these specific, highly lucrative verticals right in the New York metropolitan area. Branded as the entrepreneurial bank since 1999, they've cultivated a very specific corporate identity. They've built a rock-solid reputation on delivering customized lending solutions, rather than just handing out generic off-the-shelf products. And here's the crucial part. For the last couple of decades, they've proudly touted this narrative of disciplined underwriting. I really want you to remember that exact phrase, disciplined underwriting, because it's going to be absolutely central to the tension we'll uncover a bit later in this explainer.
Section 1, Q1, by the numbers, surging profitability.
And surging is definitely the right word here. They delivered massive growth across the board. Net income literally jumped from $16.4 million in Q1 of 2025 to $31.4 million today. Earnings per share, that more than doubled from 19 cents to 42 cents. Plus, total revenues hit a highly impressive $88.5 million. I mean, if you're looking purely at top-line revenue and bottom-line profit, this looks like an absolutely flawless quarter.
Moving on to Section 2, the massive capital raise.
But, you know, those record earnings, that's really only half the story. We've got to talk about their balance sheet. MCB actually pulled off a massive follow-on public equity offering. They issued shares at $85 a pop, raising a net total of $186.8 million. And executing something like this at scale, it shows there's some serious institutional appetite out there for their growth story. So the really crucial point is what they actually did with that money and how it fortifies their position. This capital infusion basically rocketed their Common Equity Tier 1, or CET1 ratio, to an incredibly strong 13.2%. Plus, it significantly eased those regulatory concentration concerns, which, let's be honest, are a major headache for so many regional banks right now. And on top of all that, their core deposits actually outpaced loan growth during the quarter. Operationally speaking, they're sitting on an absolute fortress of capital. Section 3, the pivot, spiking credit costs.
Now, right at the peak of all of this momentum, we suddenly see a really stark contrast in the underlying data. On one hand, the bank successfully preserved a highly resilient net interest margin of 4.08%, which means they're navigating falling short-term rates super well. But on the flip side, their net charge-offs suddenly spiked from essentially 0 to 0.73% annualized. And in the banking world, a sudden spike in charge-offs like that is a very loud smoke alarm.
And here is the specific number behind that alarm. This spike was driven by a sudden $12.5 million charge-off. But what's truly concerning here isn't just the dollar amount, it's the concentration. This massive loss was spread across just 3 specific loans. Yeah, 3. When a bank takes a hit that large from only 3 borrowers, it immediately raises some serious questions about risk concentration hiding in their portfolio. Naturally, as financial analysts covering the earnings pointed out, these abrupt credit costs introduced some serious friction to MCB's long-standing reputation. Remember earlier when we highlighted their brand as the entrepreneurial bank built on that disciplined underwriting? Well, a $12.5 million loss on 3 loans is kind of the exact opposite of disciplined underwriting in the eyes of the market. It creates this narrative violation that investors now have to weigh against those record profits.
Section 4, legal headwinds emerge.
Of course, these sudden credit issues and the resulting stock volatility haven't exactly gone unnoticed by the lawyers. SBS Law and Lowy Denenberg have both launched investigations into potential federal securities law violations and potential fraud on behalf of MCB investors. Now, to be absolutely clear, these are currently just investigations, not actual conclusions of guilt. But for an investor, this is a very tangible legal headwind that management is going to have to navigate.
Section 5, Strategic Growth in the Road Ahead. Despite these publicized headwinds, management is just aggressively pushing forward. In early March, they hosted a major investor day and opened up a brand new branch in Miami. They even have another opening pending in West Palm Beach, which is a clear expansion into that highly lucrative Florida market. And perhaps most confidently, in July, they announced a massive hike to their quarterly cash dividend, raising it from 25 all the way to 35 cents per share. And let's be real, you generally don't hike your dividend by that much if you're panicking. They also continue to carry strong, objective industry credentials. They maintain an investment-grade BB plus deposit rating from Kroll, which was affirmed just this past January. And they were recently recognized as a top 10 loan producer by the Independent Community Bankers of America. These are solid, third-party validations of the bank's structural integrity. And Wall Street seems to completely agree with that optimistic outlook. In fact, among the analysts covering the stock right now, there's a consensus 100% buy rating. They're projecting an average 12-month price target of $106. Considering the stock has recently been trading in the mid-90s, the analyst community clearly believes that their $186 million capital cushion and that incredible earnings growth will easily overpower those isolated credit losses. They are definitely showing deep faith in the bank's long-term value creation. So what does this all mean? Well, this perfectly illustrates the deep tension of this quarter, leaving us with one vital question to keep an eye on as we move through 2026. On one hand, you have record profits, a massive capital raise, and a soaring dividend. On the other hand, you have a concentrated credit shock and circling law firms. Can Metropolitan Commercial Bank's record-breaking growth and fortress balance sheet truly outrun its sudden credit risks? Only time and the next few earnings reports will tell. Thanks for joining me on this explainer, and keep learning.